Good afternoon, ladies and gentlemen. Thank you for attending the first of the Option Industry Council's webinar series for 2016. My name is Nick Ziegler, and I'm a staff member here at the OIC. I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's webinar, 8 essential options concepts for the new year. We'll explore the concept of options and their terminology, and we'll give you a base from which to start your options journey. As always, we'll cover the material, as well as your questions, in a quick 60-minute session. Our instructor today is a member of OIC's Investor Services team, Mr. Ed Modla. Ed started in the options industry in 1997, working with Blair Hull's trading group. After a number of years in the pits in both Chicago and New York, Ed traded independently and later transitioned to help investors and traders with both futures and options on futures. He joined OIC in 2014 and brings a special understanding of using options effectively, minimizing risk, and maximizing returns to our discussion. Additionally, our previous webinars can be viewed on the OIC YouTube channel. And now, ladies and gentlemen, Mr. Ed Modla will bring you our topic today, 8 essential options concepts for the new year. Ed?
Thank you very much, Nick, and thanks to everyone for joining us here this afternoon. As Nick said, we're really excited about getting the webinar series kicked off for 2016. The presentation today is on the basic level. We're going to lay a foundation for those of you getting started with your options education, and for those of you who are somewhat familiar with these concepts that we're going to go through. Hopefully, through the repetitive nature of our education here, we can drive home these concepts a little bit further. So we'll get right to it, but first we have to go through our disclosure document here. The options involve unique risks and are not suitable for everyone. Options are certainly versatile tools that you need to become familiar with before you trade them in a live account. And if you do choose to trade them in a live account, it is required that you read and review the characteristics and risks of standardized options. This is a booklet that you can get by contacting your brokerage firm and finding out from them how you can obtain a copy, so I would encourage you to do that. Also, we'll have some examples towards the end of the presentation today, but with the mathematics involved and the computations, we will not include the charges of commissions, fees, margins, or taxes. Those are important costs to consider for your account, but for our purposes today, to keep things simple, we will not include those particular costs. For those of you new to us, you might not know who the OIC is. We are the Options Industry Council. We're at the forefront of equity options education. We support the website at www.optionseducation.org, and we conduct various types of educational events such as the one here today. The funding and the support is provided by the options exchanges and the Options Clearing Corporation, or the OCC. And you see the exchanges listed here. Of course, these entities have a vested interest in seeing that options are used wisely and effectively, and of course they would like to also see the increased use of options as we move into the future. Speaking of that increased use, here's a look at annual options volume going back several decades. As you can see, there's been a tremendous growth in the options industry in recent years. There's a number of different reasons for that, but certainly a few that jump to mind. The access to options through electronic platforms and electronic trading has certainly played a role here. But I also like to point out that now, more than ever, education is available for investors. So the investing public and even the professionals, the advisors, are in a growing way starting to see how valuable options can be, not just to your sophisticated trader, but also to your individual investor. So we've seen a growing interest in what we do in spreading the word about options. And you can see there 2011, which was a fairly volatile year, had a spike in volume. But if you smooth out that curve, you can see that options volume is still continuing to rise. And due to the interest that we're seeing, we don't think that'll stop anytime soon. Now let's look at our outline for today. We said 8 essential concepts. Here they are. By the end of the presentation, you'll know what a call and a put is. You'll know what it means to buy or sell either one of those. We'll go through some common options terminology and also talk about exercise and assignment. You see also on the list towards the bottom, ITM, ATM, and OTM. That stands for in the money, at the money, and out of the money. We'll define what that is and give you some examples. And then towards the end, we'll go through an actual trade of buying a call and buying a put. Draw a P&L graph and see what the risk-reward profile looks like for those. Before we get to calls and puts, let's look at options from more of an overview perspective. As I said in the beginning, options are very versatile. And what I mean by that is if you have a market opinion that is bullish, bearish, or neutral, there is likely an options position that will fit your narrative or be consistent with your market bias. So of course it's important to do your research and develop a strategy or an approach of how you're going to evaluate the market. That could be fundamental analysis or technical analysis, or through whatever other venue you have to develop a market opinion. That would be step one. And then step two is figuring out what type of trade would you like to incorporate to profit and gain off of that market opinion. And of course, having options in your arsenal can help the performance of your portfolio. You see a few highlighted terms here: reduce risk and increase income, and certainly options can help you achieve either one of those, but they also can help you achieve both of those, which might seem contradictory at the forefront. Normally, to increase income, you have to increase risk, but it's certainly possible that with the right market forecast and with the right options trade, you can actually accomplish both of those things. Now, at the heart of it, options are contracts, and from time to time I will have an investor call and ask me if they could view an options contract and read one. And it doesn't really work like that. Options are traded electronically, they're cleared electronically, so it's not something you can physically read through, but they are contracts nonetheless, exchanged between a buyer and a seller. The buyer of the option contract pays money up front, pays the price of the option, and receives in turn the right to execute a transaction in an underlying asset. And for our purposes here today, that underlying asset is going to be shares of stock. So if you buy an option, you pay money up front, and you receive the right to either buy or sell shares of an underlying stock. If you sell an option, you are paid. You receive income, your account is credited, and you could say that you are compensated for taking on the obligation to execute a certain transaction in shares of stock if called upon to do so. That executed transaction will take place at a defined price. The option itself will outline what price that transaction might take place at, and options don't last forever. They have an expiration date, so the expiration date will also be defined. At the end of the day here, the important points are the buyer pays for rights to execute a trade in shares of stock at a defined price, and they have those rights up until the expiration date, while the seller receives income and is paid. In doing so, they take on the obligation to potentially have to execute a transaction in an underlying asset. They are under that obligation up until the expiration date of the option. Now, a good question to ask right off the bat is, how do you know whether your right is to buy or sell shares? Or how do you know if your obligation is to buy or sell shares? And the answer to that question depends on whether or not you have traded a call or a put option. There are only two types of options. There are calls and there are puts. So, depending on which one you've traded, you will then know if your rights include the buy, to be able to buy or to be able to sell shares, or if your obligations include the requirement to buy or sell shares. That actual transaction that we're talking about, as you can see here, is for 100 shares of underlying stock or 100 shares of an ETF. Now, if you think about what I said earlier just a second ago, there are four sides that you could potentially be on for an options trade. You can either buy or sell a call option, or you can buy or sell a put option. Each of those four sides has either rights or obligations attached to them. So we can break those four pieces down, and we'll start entirely from the call side. This slide references call options only. If you are a call buyer, well, the first thing we know is you bought an option. That means you paid for rights. And in this example, with a call option, you have bought the right to purchase or buy 100 shares of underlying stock. Again, the exact price that you have that right to will be defined in the options contract, and you have that right up until the expiration date. Now, here's some common terminology that you will come across through education or discussion with other investors. If you buy an option and you own it, you are known to be long the contract. That's consistent with any option. And here you're seeing that if you buy a call, you're long the call contract. The same thing would be for put contracts. If you are a seller of a call option, the first thing we know is you are paid premium, you're credited into your account, and you've taken on an obligation. For a call option, your obligation would be to sell 100 shares of underlying stock at a specified price, and you are under that obligation up until the expiration date of that option. Again, some common terminology you'll come across. Where the buyer is long, the seller is short the contract. Another very frequently used term is writer. So if you're an option seller, you are the writer of an options, or an option writer is a seller of options. You'll see those terms used very frequently. Now let's take a look at the back half of these two, the put options. If you buy a put option, again, you're paying for the right to execute a transaction. In the case of a put, that right is to sell underlying stock, 100 shares specifically, and the price at which you have that right will be defined in the option contract, and you own those rights up till the expiration date. Consistent with call options, buying or owning an option means you are long the contract, in this case, long the put contract. If you sell a put option, you have received the price of the option, it's credited into your account, and you've taken on an obligation. For put options, that obligation is to buy underlying shares of stock at the specified price, and you have that obligation up until the expiration date. You will be required to buy shares of stock if called upon to do so. You're under that obligation. And again, the consistent terminology here, if you're selling options, you're short, and if you are selling options, you are also known as the writer, or you have written the option. Now, a few times here I've mentioned the specified price and the expiration date, and those are further contract terms of the option. So we'll break those down and clarify what terms exist for each contract. First of all, the actual underlying stock needs to be specified. For our purposes here today, we use hypothetical company XYZ with stock symbol XYZ. But each contract will define which symbol or which stock is going to trade hands. You also have the unit of trade defined. We've said that that's 100 shares. The word usually is on this slide here for a reason. First thing that comes to mind is that it is possible for the unit of trade of 100 shares to change. This is usually the result of corporate actions, which could potentially be a stock split, or maybe a merger or spin-off. Certain types of corporate actions that affect shareholders may affect this unit of trade. So it's worth pointing out and being aware of. They don't happen too often, but it's certainly possible. If you want to find out more about that, we have a very thorough course on our website under the Options Education Program in the course catalog titled Contract Adjustments. So if you want to know more about this possibility, go to the Contract Adjustments course on our website. That specified price that I've talked about a few times is known as the strike price or the exercise price. This is the price at which the executed transaction of the purchase or sale of shares will take place. And of course, the expiration month is also defined. Sometimes the expiration day is defined depending on the type of contract it is. But those four contract terms will exist. Now, if the option buyer would like to execute their transaction, or if the option seller is required to execute the share transaction, the industry will go through what is known as exercise and assignment activity. So let's start looking at things strictly from the buyer's perspective. We know that the option buyer has paid for rights. In the case of a call option, they've paid for the right to buy 100 shares of stock at the strike price, and they own that right up till the expiration date. If they would like to do that, if they would like to purchase the shares that they've paid for the right to do, then they will inform their broker that they would like to exercise their contract. That's an underlined term for a good reason. Very important to be familiar with that term. You'll come across it quite a few times. It's also very important to understand the communication process that your brokerage firm requires. The brokerage firm will have cutoff times after which they won't accept exercise instructions. So if you are in a position where you would like to execute this stock transaction that you've paid for the right to do, find out from your brokerage firm, how do I tell you that I want to exercise my contract, and at what time can I tell you up until? So I'll run through this one more time. Down the right side for a put, the buyer of a put option has paid for the right to sell 100 shares of underlying stock at the strike price of the option. If they choose to do so, they will inform their brokerage of their intent to exercise their put contract, and they will, in turn, be selling shares of stock at the strike price. Now, you see the last bullet point down here? Only option buyers may exercise an option contract. That means buyers have choices, and you've paid for those choices. A buyer can't be told that they need to exercise their option or forced into exercising their option. The buyer has choices, whereas sellers do not. So only buyers can exercise. Now let's flip the script here and look at things from the option seller's point of view. A seller receives premium, they are paid, and they take on obligations. In the case of a call option, they've taken on the obligation to sell 100 shares at the strike price if they are assigned. And that's another underlined term. Very important to be familiar with that term. On the side of the put, if you've sold a put option, you are under the obligation to buy 100 shares of underlying stock at the strike price if you are assigned. Now, the communication lines work the opposite way here. Whereas the buyer informs the brokerage firm of their intent to exercise, sellers don't have a decision to make. They don't have anything to communicate to their brokerage firm. The communication goes the other way. Brokerage firms inform sellers that they have been assigned. So again, very important to communicate with your brokerage firm and find out, how do they inform you of your assignment, and when do they inform you of your assignment? You see down at the bottom, very similar comment as we did before for the buyers. Option sellers can be assigned, option buyers cannot. So in other words, option sellers don't have choices. They have been paid to take on obligations, but they cannot choose to be assigned or request to be assigned on shares of stock. They can only be assigned at the option holder's discretion. Now, it's logical to ask, when might this occur? At what point in time may exercise or assignment take place? Now, there are two types of option contracts. One of them is called European style. We're not going to get too much into that because it generally references index options, but quickly, European style means that the option contract can only be exercised at expiration. Equity options, on the other hand, are American style. That means that they can be exercised at any time up until expiration. You see here that the buyer may exercise at any time and they are in control, whereas the sellers could be assigned at any time and is not in control. Now let me elaborate on the underlined phrase, at any time. Exercise and assignment activity takes place after the closing bell. So it's not possible for someone to sell an option in the early morning hours of trading activity and then in the mid-morning hours of trading activity be informed by their brokerage that they've been assigned. It doesn't work like that. If an option buyer instructs his brokerage firm to exercise an option, that activity will then take place after the closing bell when the trading day is done. So you can trade your options throughout the day knowing you can't be assigned. In fact, one thing you can always do is close your option out at any time. The buyer or the seller can do this. The buyer, of course, has purchased an option in the options market for a certain price. And if they think they could take a profit or maybe take a loss and exit the trade, they can execute a transaction to sell that option back to the market and close their position. Sellers can do the same thing. They can buy the option back from the options market and avoid any future risk they have with a move in the underlying or possible assignment risk, knowing you can't be assigned during the trading day. So if you buy the option back during the trading day, you avoid any assignment risk that could potentially take place after the closing bell. And in fact, this process of closing out trades is the way most options trades are closed. Very few of them go through the exercise and assignment procedure. Approximately 70% of options that exist are closed at some point, with the remainder 30% going through exercise and assignment activity or expiring completely worthless. Now let's talk a bit about expiration days and define them. Monthly standard expirations are the third Friday of every month. If Friday's a holiday, then it could be on a Thursday. But this is your standard monthly expiration, and it represents the last day that you could possibly trade the option, and it's also the last day that you could possibly exercise your option. Now, the available months that exist could vary from one symbol to the next, and in fact, they often do. So it's important to know for the symbol you're interested in trading, what available months do I have? And for the designation of a particular month, you will know that the monthly standard expiration date specifically is the third Friday of the month. Now, most of you are probably familiar with more frequent expirations that exist beyond just this third Friday, and you're about that. There are also weeklies, which are popular today. There's also quarterly options, which are a little bit less frequent, but certainly the exchanges can make a decision to list more options if they perceive that more volume may be traded on those stocks. And I think it's upwards about 300 to 400 symbols currently trade weeklies at the moment, and that is due to the perceived demand by the exchanges who saw a demand and a need to list more expiration dates that would be traded. So it's up to the exchange's discretion to decide which expiration dates to list, and a lot of symbols do have weeklies listed. Now let's talk about option premium and what it means and how to calculate what exact dollar amount changes hands when you trade an option contract. We've said already that a buyer pays upfront a non-refundable price. That is a debit that goes out of their account as soon as they make the transaction. An option seller receives that premium. It's an immediate credit into the option seller's account. That premium is kept whether they're assigned or not. The profitability of the trade for each the buyer or the seller depends on what happens subsequent to the options transaction. The price movement of the option, the movement of the underlying, what happens in the market will then determine profitability. But let's stick to option premium here. Quoted prices and stated trade prices are quoted in terms of one share. But as we've said a few times today, options represent 100 shares, and the transaction is for 100 shares. So if you see a quoted price in an option or a last traded price of $3, you have to multiply that number by 100 to come up with the actual dollar amount. So if you buy an option for $3, you've spent $300. If you sold an option for $300, you've received $300 into your account. And of course, we're excluding commissions and fees. Now let's go through an example. And option quotes such as this one here could be presented in different formats depending on the data vendor that you use, but they will all contain the necessary information and the 5 components that you see on the screen here. First of all, you have our fictitious company XYZ. This is the underlying stock that where shares will trade hands in XYZ if exercise and assignment activity takes place. We have the expiration month. In this case, it's January. We know that since just a month is listed, that represents the third Friday in January. If it was a weekly option, then you might see that designated somehow as January week 1 or January week 2, and then that would signify which Friday within January this option expires. Without that information, just seeing January, this is a standard monthly option which expires on the third Friday in January. Next is the strike price, the price at which the executed trade based on exercise and assignment activity will take place here, $40. This is a call option, as you can see, so that means that the buyer of this option has purchased the right to buy shares at $40 at that strike price. And then finally, you have the premium, $3.20. And as we just referenced, $3.20 is on a per share basis, so the total premium here is $320, excluding commissions. Let's run through this from the buyer and seller's perspective and just state what it means. If you bought this option, it means you paid $320 for the right to purchase 100 shares of XYZ stock at $40 a share. You own that right up through the third Friday in January. If you sold this option, you receive $320 into your account, and now you are under the obligation to sell 100 shares of XYZ stock at $40 a share if you are assigned. You are under that obligation through January expiration. Now we're going to move on to our essential concept, number 6, in the money, at the money, and out of the money. These terms are an attempt to characterize or distinguish each option by comparing the strike price to the stock price. In other words, it places the option on a map and informs the investor whether or not the strike price gives the buyer a favorable price to execute their transaction versus where the stock price is currently trading. In other words, for the case of calls, and this entire slide is referencing calls, if you are able to exercise your option and purchase shares at a better price or a more favorable price than you could get in the open market, then that option is known as being in the money. Take the example on the top of the screen, January 40 calls. If you buy this option, you have the right to purchase shares at $40. That's better than the current open market price of $50. That's favorable, and that's an in-the-money option. Effectively, any option with a strike price below $50 is going to be in the money. On the flip side of that, the April 60 call gives you the right to buy shares at $60. The stock is trading in the open market at $50, so that $60 price is not favorable. It's above the open market stock price, so that option is out of the money. Here, effectively, every option with a strike price that's above $50 is going to be out of the money. At the money is very simple. It certainly just means that the strike price and the stock price exactly equal each other. Now, none of these designations define a requirement or a prerequisite towards being able to exercise your option. If you're an option holder, you can exercise it at any time you want. It's worth pointing out at this point here a process that is known as exercise by exception. And this is something that does trip people up, and we get frequent questions about this from not just individuals, but from the professionals as well. There is a default process in the industry on how to handle the situation where an option holder does not communicate to their brokerage firm what they want to do with their option. In other words, what do we do if the option holder doesn't inform us of their intention? At expiration, there's a few different ways you can handle that, but the industry standard is to exercise an option on the holder's behalf if it is in the money by a penny or more and the option holder has not communicated any instructions to their brokerage firm. To repeat some of that, of course, there has to be some kind of a default process in the industry. So if you don't communicate anything to your brokerage firm, you will fall into this category. What's the default process? And if you own an option that is out of the money, nothing happens. If you own an option that's exactly at the money, nothing happens. But if you own an option that's in the money and you don't give your brokerage instructions, it will be exercised on your behalf, and that's the way the industry works. So make note of that and be careful of it. It's called exercise by exception. You might want to look more into it. But you want to make sure that you're not surprised and end up with a position in shares in your account that you didn't expect to have. If you don't communicate instructions, you still may go through that exercise process because of the X by X procedures. Now let's look at in the money, at the money, and out of the money for puts. Again, we'll take a similar approach here. If you can execute the transaction at a favorable price, that's in the money. In the case of puts, we'll start at the bottom. The April 60 put gives you the right to sell shares at $60. That's better than the price of $50 that currently is going for the open market, so it's more favorable. Therefore, it's in the money. At the top of the screen, the January 40 put gives you the right to sell shares at $40. That's worse than the stock price of $50. That's below the stock price. So that put option is out of the money. And again, at the money is exactly a matchup between the $50 strike price and the $50 stock price. We'll go through a few examples here. I won't go through every single one, but as you go through this webinar again and review it, I encourage you to take your time and go through these and quiz yourself. Let's look at the top one. Stock price is at $55. Your option is the 65 strike priced call. So if you own this option, you could purchase shares at $55. At $65, excuse me. That is unfavorable. That is worse than you can get in the open market at 55. Therefore, this option is out of the money. And as you can see, you can continue to do these on your own, but let's look at the bottom example. With the stock price at $22.55, we are now going to look at the $22.50 call option. You have the right to buy shares at $22.50. That is favorable to $22.55. That's a nickel better. The strike price is below the stock price, and this is a call option, so this one is in the money. Now, moving forward on our next concept, we're going to talk about a breakdown of option premium. You can break up the price of an option into two pieces, specifically intrinsic value and time value. We'll define each one. Intrinsic value is the amount that the option is in the money by. In other words, for an in-the-money option, it is the difference between the stock price and the strike price. By default, you could probably see here that at-the-money options and out-of-the-money options don't have any intrinsic value because they are simply not in the money. Time value is any excess premium above the intrinsic value that exists in the premium of an option. And there are deep studies that have been conducted on time value, but basically from an overview perspective, it accounts for the possibility of movement in the underlying or movement in the market that could affect the intrinsic value of the option. It accounts for volatility in the market that could move the underlying and change the value of the option. This time value is the portion of option premium that decays over time with each passing day. And as you reach expiration time, there is no time value left, therefore there's no time decay. So you've reached a point of zero at expiration. The only thing that could possibly be left in the value of an option at expiration is its intrinsic value, because there simply is no time remaining. I'll give you examples here. This next slide is very simple to grasp. So if it looks very simple, don't think too hard about it. It's because it is simple. In the money calls and puts have intrinsic value. We just defined what intrinsic value was. It is the amount that an option is in the money by. So an in the money option certainly has some value for intrinsic. It may also have time value depending on how much time is left before expiration. Conversely, at the money and out of the money calls don't have intrinsic value. The simple explanation of why is they are not in the money. They are at the money and out of the money. So any premium that those options have or any value that those options have is entirely time value. Now let's go through an example here and break it up. If you have a stock that's trading at $53 per share, we're going to take a look at the January 50 strike price call that is trading at $5.20. First question is this option in the money or not? Well, if you're the holder of this option, you can buy shares at 50. That's better or more favorable than the $53 going in the open market, so it's in the money. That means it has intrinsic value. The amount is the difference between the stock price and the strike price, which is $3. The total option premium is $5.20. So by doing simple subtraction here, $5.20 in total premium minus the $3 we could calculate in intrinsic value leaves us with time value of $2.20. Let's go through one more example. You see on the bottom right here, the 60 strike price call. Here, if you own this option, you have the right to buy shares at 60. That is unfavorable compared to the $53 the stock is currently trading at. It's a strike price that's higher than the stock price, so this call option is out of the money. Therefore, it is not in the money, and therefore the intrinsic value is zero. If the intrinsic value is zero and the total premium for this option is being quoted or traded at $2.10, that means all of that, the entire $2.10, is time value. Now let's go through an example here, a little quiz. With the stock price at 77, you have the 70 strike price call option that we can see quoted at $10.50. First question is this option in the money, at the money, or out of the money? If I own this call, I can purchase shares at $70. That's better and favorable to a stock price in the open market of 77. Therefore, it is an in-the-money option. The amount that it is in the money by represents the intrinsic value. That's 77 minus 70, or $7. The difference between the option price and the intrinsic value is the time value. So this $10.50 premium is made up of $7 in intrinsic value and $3.50 in time value. Again, these examples will be useful for you to go through more slowly when you go through the webinar again on your own time. We'll look at the bottom example here with the stock price at $12.50. We want to look at the strike price $12.50 call option. Now this option is clearly at the money. The strike price equals the stock price. The premium in the open market is $1.50. An at-the-money option is not in the money, therefore it has no intrinsic value. This entire $1.50 of premium is time value. So there's the concepts. We're going to go through a few examples now. And before we get here, I want to point out that these two examples, one of them is buying calls and one of them is buying puts, are not to be received as an advocation that these trades are common or recommended for beginners or to initiate your first options trades. They're simply for education purposes. It is quite possible that you may never buy a call or buy a put. You might, but you might not. It's up to you. But from an educational perspective, it's important to understand how these work. And then as you move further down in your education, you'll decide for yourself what type of option spreads you're comfortable with and what type of options trades you want to incorporate into your portfolio based on the market outlook that you have. So here we'll start with the buying calls example. Little recap. If you buy a call, you have paid up front for the right to buy 100 shares of stock at the strike price, and you own that right up until the expiration date of that option. You've paid the premium. That's a debit right out of your account. Here's the P&L graph from a general perspective of owning a long call option. You can see to the downside that your risk is limited to the amount that you paid for the option. And of course, that's for the duration of the option. If you recall something I said earlier when we talked about exercise and assignment, if you exercise your option, you no longer own an option, you own shares. And that may have a very different risk profile. Well, I shouldn't say might. It definitely does have a different risk profile than just owning the option does. But while you own the option, your risk is limited to the price you paid. On the upside, there's no cap or ceiling on how high a stock price could possibly go. So your increasing stock price will provide unlimited profit potential to the upside. Now let's take an example and put some numbers on this. Stock XYZ is trading at $60 a share. You think the stock's going higher. You want to limit your downside risk, so you compare buying shares to buying the option, and you decide to purchase a 60 strike priced call option that expires in 3 months, and you pay $3 for this option. Again, we know that this is based on 100 shares, so $3 in premium times 100 shares equals a total cash outlay of $300. Now, if you're going to construct your graph, which I encourage you to practice and be able to do, you simply would calculate your profit and loss at various stock prices at expiration. So let's start at 63. We picked this one for a reason, and you'll see why in a second. If the stock ends up at $63, this call option will then be $3 in the money. At expiration, there's of course no time value, only intrinsic value, and the difference between 63 and 60 is $3, so this in-the-money option has a value of 3. We paid $3 to begin with, so our total profit and loss here is 0. You can see that there's an advantage and disadvantage here. We limited our downside risk. We had a much smaller cash outlay when we bought the option, but with a move up in the underlying stock, we did not profit. All we were able to do here was pay ourselves back for the price that we paid for the option. Now you can fill in as the stock goes down, and you can see how this works out. At 60 or less in stock price, this option is either at or out of the money. Therefore, it has no intrinsic value. Of course, it has no time value either at expiration, so no value at all. That $3 we paid for the option is not going to go away, so the total profit and loss as we go lower in stock price is going to be $3 at these particular stock prices. And as you move lower, if you picked 40, 30, or 20 for stock prices at expiration, your profit and loss would still show up as $3. That's the benefit. That's the downside limit that you're looking for. Now let's look at this from the upside. Take the stock price at 70. Now this is an in-the-money option. Strike price is below the stock price. We can buy this stock at a favorable price compared to where the stock is trading. It has intrinsic value. That amount is $10. We paid $3 for the option, so our total profit and loss is $7. You will see if you picked higher and higher stock prices that our profit continues to go up, but it will always underperform the actual stock move by that $3. So you give up some of that upside potential to achieve much greater downside protection. Once you've drawn a graph like this, you can then turn it into a P&L graph such as this one and put actual numbers on it so you can visualize where the profit and loss is. And I encourage you to be able to do this. It's very useful. And here you can see where your break-even point lands at 63. That is the price at which your option is worth $3, which pays you back for the amount you paid for the option itself. And in comparison to the dashed line, which is the long stock position, you can see to the upside as the stock price moves higher, your option underperforms. But on the downside, you have capped your risk while the option exists, whereas purchasing stock does not have that luxury. So again, there's advantages and disadvantages. And you may be asking yourself for an overview here of why would you buy calls? Well, certainly the graph explains it. It shows you where your risk and reward is, and you can compare it to the stock price. So if you're comfortable with the risk profile of the option, then you may be interested in buying calls. Certainly if you're bullish on a particular stock, this is when call buying would pay off. Your cash outlay at the beginning is much smaller as compared to purchasing stock outright. You may expect to exercise the option and buy the stock eventually, or close the option by selling it back to the options marketplace, but the option buys you some time. You can wait and see if the underlying moves the way you thought it was going to move, and subsequent to that, if you decide you would like to own shares because your market directional bias is confirmed, you can go ahead and exercise your contract and buy the shares. Then, of course, it's important to focus on the number of contracts. This result will be different for each trader. It's important to consider your financial condition, but also the confidence level that you have in the trade and your risk tolerance for the trade. And when you put all those factors together, then you'll be able to determine the number of contracts you'd like to trade. Now, the last thing on our list here today is to go through a buying put example. We'll go through this the same way we did buying calls. First of all, the overview look. A put buyer has paid money up front and has purchased the right to sell underlying shares of stock at the strike price, and they have this right all the way up to and through the option expiration date. You paid the premium. That's a debit right out of your account. You don't get that back, and now you have rights to sell shares of stock. The P&L graph looks very similar, except the arrow is pointed the opposite way. So looking at this from the loss perspective, as the stock price increases, your right to sell shares at the strike price starts to look worse and worse because the open market value of the stock is getting higher and higher. The value of your right to sell shares at this lower value is not going to be favorable for you. So as the stock price increases, the option will lose value, and here this P&L graph represents at expiration. The limited risk that you have is what you paid for the option, with the profit potential to the downside. If the stock loses value, then all of a sudden your right to sell shares at the strike price continues to look better and better. There's a little difference here compared to calls, whereas the call has unlimited profit potential to the upside because there's no cap on how high a stock price can go. Put options have substantial profit potential, not unlimited, because they are bounded by zero. The stock price can only go to zero, so there is a limit on how much you can make here, but still defined as substantial. Now we want to put numbers on things and draw the graph again. Stock XYZ is trading at $36 a share. You're bearish. You think the stock's going lower. You want to limit your risk to the upside and not take on the significant risk of selling short outright shares in your account. So you look to the options market and you buy a put option with a strike price of $35 that expires in 3 months, and you pay $2.25 for this option. Again, that quote is on a per share basis, so 225 times 100 equals $225. That's what you paid. Now let's get to our chart and pick stock prices. First of all, 32.75. Well, if the stock price ends up there, this 35 strike put option is in the money. We can exercise it, sell shares at 35 versus an open market price of 32.75. That's favorable. The strike price is higher than the stock price. That means it's in the money. It has intrinsic value. The amount of intrinsic value is the difference between 35 and 32.75, which is 225. That's exactly what we paid for our put option. So at a stock price of 32.75, we have paid ourselves back what we paid for the option, and our net profit and loss is zero. Looking to the upside, if the stock rallies, say to $40 a share, we now have an option that is out of the money. The 35 put gives us the right to sell shares at 35. That's worse than we could sell in the open market at 40. Option's out of the money. That means it's not in the money. That means it doesn't have any intrinsic value. This is at expiration, so it also has no time value. So it's had a value of zero. We paid $225 and we don't get that back. So our loss is $225. As you pick stock prices higher and higher, $50, $60, or $70, you would see that our net profit and loss stays at $225, whereas if you were short outright shares, you would stand to lose more and more as that stock rose in value. To the downside, this is where you profit. Let's take a look at the stock price at 25. That's an in-the-money option. 35 strike price compared to 25 is $10 of intrinsic value. That's the value of my put because time value is zero at expiration. Minus the cost of the option gives us a profit of $7.75. Now this is not as much as we could have achieved by selling short the shares. Again, you give up some profit potential by buying the long option. What you get in return is a substantial decrease in your possible loss. Now you can take these numbers and then transform them into the P&L chart. And here it is where you can see your P&L break-even point at 32.75 and an increase in profit as the stock drops, a loss as the stock moves above your break-even point. And once you reach $35 a share and above, that option isn't worth anything at expiration. Therefore, you've lost the entire amount of premium that you spent, in this case, $2.25 or $225. Now, motivations for buying puts, of course, the P&L graph again outlines it for you. That's why I encourage you to get comfortable creating and drafting P&L graphs for yourself. If you're bearish on the underlying stock and you want to capitalize on that, you can consider buying a put option. You will profit if the stock price declines enough to pay you back for the cost of the put option and then some. It's an alternative to selling short shares, which can be an extremely risky trade. Of course, being short stock in your account could also come along with a margin requirement. So buying puts certainly can be beneficial in a downward moving market and certainly offers an alternative to selling stock short the same way that buying calls can be looked at as an alternative to reducing risk versus buying shares. So there's our example of puts, and there's our 8 essential concepts for today. I would encourage you to go through these concepts again and review the webinar at your own leisure. Visit optionseducation.org and take the MyPath assessment to see where you fall in and go through the Options Education program. The course catalog is very good. There's videos, there's podcasts. There's also a strategies and advanced concepts section which has several dozen strategies outlined with a full-page description of P&L graphs and how options are affected, what your motivation is, what your P&L break-even points are, and how to calculate that. So there's a strategy section. There's a virtual trading system so you can practice trading. All of this, again, free of charge, sponsored by the exchanges, so I would encourage you to check that out at your earliest convenience. And here's a list of our website right here. It's on the board, optionseducation.org, and YouTube channel. So Nick, if you're still here, I'll turn it back over to you to wrap things up.
Absolutely, Ed. Well, thanks so much for this in-depth discussion of a lot of these concepts. We've got a number of fairly savvy investors on the line here today, and I think it's really interesting to see some of the questions that have come past. So without further ado, let's jump into those. One of the questions that came in here was about out-of-the-money options. Can you exercise an option if it is out of the money?
It's a good question. We get this question quite frequently from investors that aren't familiar with this process. The answer is yes. There are no preconditions that need to be met in order for an option to qualify as being exercisable. In other words, the option holder can exercise their option at their discretion for whatever motivation they have, and it could even be illogical. But the point is, if they instruct their brokerage firm to exercise their option, that will be honored, whether the option is in the money, at the money, or out of the money. By the same token, they could instruct their brokerage firm to abandon an option at their discretion. Keep in mind, the X by X process is just a default. The holder can always make a decision, and it doesn't matter if the option is in, at, or out of the money. They can exercise or they can abandon. They can do whatever they choose. So the answer is yes, an out of the money option can be exercised if the option holder chooses to do so.
Ed, we had some questions that came through about premium, because that's, I think, kind of an unknown concept for some first-time options investors. Who actually sets the premium price?
Well, the premium price is ultimately set by market participants. Now, of course, everyone is familiar with how you can calculate value, a value for any particular option. Certainly sophisticated trading firms are running those kind of mathematics and those algorithms all day to calculate a value. But the premium that you see in the market is more strictly and simply a function of market participants, and that could be individual investors, professional trading firms, institutions, any of the above, who place orders to buy and sell options. Effectively, if there is a matched trade between a buyer and a seller, of course, the trade takes place and is executed at that premium. The options market is continually finding out or discovering where the middle ground is, where bids exist and offers exist simultaneously with no trading and no matching occurring. And that process is developed throughout the trading day based on the bids and offers being placed by any market participant. So even though you can calculate a theoretical value for an option, the actual premium and the bids and asks that you see are just simply a function of supply and demand from any market participant.
Ed, I think, like I mentioned, there's a couple savvy investors we've got here today, and I think they're familiar with the OIC website and some of the tools and resources we have there. This investor writes in that he mentioned that he saw that time decay is not linear. Can you explain a little bit about what that means?
Yeah, I can touch on that, and you're certainly right. That is a savvy question to ask. Time decay not being linear means that from one day to the next, the amounts of time decay is not consistent throughout the lifespan of the option. And let me elaborate this way. If you have an option that has 100 days till expiration and 1 day expires, now you have 99 days till expiration. Well, that 1 day really didn't have that great of an effect. You might not even notice that the time decay occurred in the option because going from 100 to 99 is not so significant. But on the other hand, if you go from 3 days to 2 days, all of a sudden 1/3 of the life of that option has just been expired. So the time decay of an option tends to increase as you get closer to expiration. Now, it's a fairly widespread and accepted industry knowledge that when you get to the 30 to 45 days until expiration time frame, that's when you will see on a chart that time decay starts to increase. And it continues to increase all the way through expiration day, with the fastest acceleration being at the end. Now, that doesn't always mean that the last week or the last final days are the best time to sell options, because of course, there's a balancing act. With less time, there's less premium. And when you sell options, of course, you take on obligations and risks. So you have to evaluate, is the amount of premium I'm receiving worth taking on the risk and the obligation that comes along with it. But as far as time decay, specifically to the question, Nick, time decay accelerates as time comes closer to expiration. That 30 to 45 days out time frame is referenced on our website in graphical form. I believe this is on the Strategies and Advanced section page under the Greeks. If you look under theta, there will be a graph there that shows this. And time decay starts to accelerate at a more rapid pace as you get closer to expiration, with the quickest acceleration of time decay in the final few days before expiration.
Ed, I know this might be a little bit specific to an individual brokerage, but are there typical methods that a brokerage firm uses to notify the seller that they've been assigned?
It's a really good question, and the answer really is no. Each brokerage, of course, has different levels of service. So it's important to know what communication methods they have. Some may be entirely electronic. Others may have some more form of direct communication. But by and large, each brokerage firm decides for itself what level of service they provide and how much client service they are able to facilitate. And of course, costs and business models all come into that equation. But at the end of the day, each brokerage firm could be different. There is not a standard method. So as I said in the beginning of the presentation, just very important to contact your broker if you're not comfortable or happy with their process and it's not something you would like to pursue trading options with. Of course, that's what investigating brokerages is all about. And you can call around and find out what methods do they use to communicate with their investors regarding options trades, and compare advantages and disadvantages there, and then make a good decision on which broker to use from there.
Ed, if a stock price is in the money for the buyer of an option, does that mean it's out of the money for the seller?
Well, the option itself is designated as in the money. So if you take, for example, the call options, as we said during the presentation, if the strike price is below the stock price, that option itself is in the money. That means if you are the buyer or you own the option, you own an in-the-money option. If you're the seller and you've sold that option, you are short or you are the writer of an in-the-money option. So the designation of in the money, at the money, and out of the money applies to the option itself. It doesn't matter if you're the buyer or seller. It's not going to be any different. For that one particular option, you either have a position in an in-the-money option, an at-the-money option, or an out-of-the-money option, and it would be the same for both the buyer and the seller.
Ed, is there a general rule of thumb that someone should use before they sell an option, or whether the price is up or down towards the strike price? Is there a general rule of thumb that an investor should use that they should start thinking about either selling or getting out of a position?
Well, general rule of thumbs are difficult to speak to because each investor can make a decision for themselves, and it's hard to get into details. But I will say when it comes to selling options, you understand what your obligations are. So it's always a good idea to think ahead about those obligations and decide, am I comfortable selling shares or buying shares at this particular strike price if I am required to do that, or if I am assigned on this option? Am I comfortable making that transaction? So that's your first step. One other thing you can do is try and target the sale of your option to your forecast of the underlying. And let me explain that a little bit. If you believe that an underlying is going up to a certain price, but not beyond that price, and you are looking at selling call options, maybe as some sort of a spread position, then you would likely want to target a call option with a strike price very close, if not at, your target price. Because generally, the options that you've sold will pay off best, of course, if the underlying is at or out of the money. So you can target that price depending on your spread. You can also just use your market analysis, whether it's technical or fundamental analysis, to decide at what point do I think this option will be out of the money, and then in order to collect the most premium, sell an option with the strike price that is closest to that target price you have based on your analysis.
Ed, we're a little bit over our stated runtime of 60 minutes, but I think we will take this last question because I think it's a great one to lead into some of our further, more in-depth discussions. And this investor would like to know how much of using the options instruments is rooted in creativity?
Well, I'll take that question in a certain direction. The options instruments, assuming you mean calculators and the running of values to come up with theoreticals, the only unknown involved with running these types of calculations is volatility. So when you say creativity, well, there's a pretty well-defined structure in mathematics on how to run the calculations to come up with hypothetical values for options. But the volatility component can be shifted based on the trader's own interpretation and own perception. So as demand comes into the market, professionals will generally increase volatility and hence increase the value of options. As sellers come into the market and are continually selling options, option prices are lowered, and therefore the volatility component is then adjusted accordingly. So I'm not sure if I spoke directly to what that question meant, but if it was with regards to how do you run calculations and how much liberty is there when trying to calculate the theoretical value of an option, the liberty is within the volatility component itself, which can be toggled up and down based on what the options market is doing with respect to supply and demand from market participants. Professionals are throughout the day constantly moving volatility up and moving volatility down to find that balance I talked about where you have bids and offers but no executed trades. That balance is continually trying to be found, and by moving your volatility component and affecting the price of the options, you can accomplish that.
Ed, do you have any closing thoughts for our listeners today?
Well, you know what? I really enjoyed being here. As we pointed out in the beginning, this was the first webinar of the year. We're really excited about the long list of events that we have planned. So I enjoyed presenting it. I encourage you to go to our website and check out the options education program there. A lot of things we talked about today are logical, but it does take repeating the material over and over again to drive it home. Some of you may have gone through these concepts before or attended our previous webinars before, and it doesn't sink in overnight. It takes some time. So I would just encourage you to concentrate and stay committed to this. Stick with our website and our presentations that we provide here, and I think that over time you'll get more and more comfortable, and gradually light bulbs start to come on, and you'll be more comfortable moving forward to either trading options live for the first time or enhancing what you're doing already. So enjoy being here today, and I appreciate everyone for showing up, and hopefully we'll see you again soon.
Ladies and gentlemen, thank you for your time today. And if we weren't able to get to your questions, we do have our investor services desk ready to help. And of course, Ed is a member of that team, so feel free to reach out to them at options@theocc.com. Additionally, our webinars are available on the OIC YouTube channel, so you can review a number of strategies and concepts at your own pace. Many of you also asked about further education. Please visit optionseducation.org, the OIC's website, and see the Getting Started section for further reading. And of course, make sure to check out the website in the upcoming weeks for our next sessions. Ladies and gentlemen, thank you again for attending, and we hope to see you again next time.